it's for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are traded and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, and futures, by the way. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Very important. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, fantastic. Now, we are going to be doing a special webinar today. It's going to be on futures, all right? And I'll be talking about it. We did an article on, well, since this is PhilStockWorld, I guess I can find it here. We did an article on the weekend, which I hope you guys read, and if you didn't read it, take the time to check it out. And the article on the weekend was using futures to hedge against market corrections. All right, and we talked about, as an example, a futures trade we did last week. We did another one right out the gate on Monday morning that also made some good money. And the best time to trade the futures is really pre-market, because you're acting when other people aren't acting yet. In other words, the vast majority of people in the markets are going to start trading at 9:30. So whatever news happens before the market opens, it will be reacted to more strongly, not only reacted to, but more strongly reacted to after the bell than before. So you get a really good chance. If you're a futures trader, you have a huge advantage because you get to go first. You get to make your bet when you hear the news. You don't have to wait an hour and a half or whatever for the news to come out. So if you're an early morning person, futures trading is fantastic, and that is when we make most of our trades, is early in the morning. As you can see here, these trades were initiated at 5:50 a.m. All right, so very, very important that you understand that you don't have a very big advantage during market hours trading the futures, which is unfortunately we're doing this webinar now, because you're getting the news at the same time all the retail people are getting the news. So they're going to react as fast as you are. So you're not going to have an edge in the futures the way you do in the morning. The edge you have in the morning is a very, very significant edge. Any time, as you know from like Wall Street, you know that movie Wall Street with Michael Douglas, any tiny, tiny informational edge or ability to act edge that you have can tip the scales in your direction and make you a huge amount of money. That edge that you have pre-market when you're a futures trader is huge. You know, also post-market. Also when you hear earnings and you understand like a certain, like Amazon or Apple or Netflix, and you understand they're a big component on the NASDAQ, and that if they have earnings and they go up or down, it's going to take the whole NASDAQ with it. You don't have to bet on Apple. You can bet on the NASDAQ moving when Apple does something. And again, when the markets are closed, because you have such a jump on everybody else who's going to react to these things. Now, my PSW members know that right before I do these webinars, I run through the news because I always like to know what's going on. And especially when you're doing futures trading, the whole point is to know what's going on right this minute. So these are a bunch of news items that came off of Bloomberg that I was thumbing through when I was sitting down right before I got started. And I'm not going to go over them now because there wasn't anything that exciting. But I was just, you know, this is what you want to do. It's when you see something, And more importantly, when you see something but other people haven't reacted to it yet, that's the key. It's that you see something and say, well, how come that hasn't moved the market yet? And the more you do it, it's really practice. The more you do it, the better you learn it. You'll get good at it. You'll understand it. We also talked here. I don't want to get too introduction because this article is an introduction, so read that, please. We talked about the margin requirements of future trading. People are unnecessarily scared of trading the futures because they think there's some horrible thing and people can get margined out and go broke and blah, 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 blah. It's like, it's not untrue, but if you look, when you have, this is think or swim. When you're on a trading screen for the futures, like this one, and you've got this is ES, the S&P futures. If you hit this button DB, I don't know what it means, but it says dashboard. Okay, so I guess it means dashboard. If you click that button, it then shows you the margin requirement. These margin requirements do change. It was 4,500, so I guess the market got more volatile. They do change, so it's not a consistent number. But it tells you how much a tick is. In other words, it moves in 25 cent, not 25 cents, 0.25 points of the S&P. It moves this ES mini S&P futures contract, which is September 15, which means it's good until September. It moves in 25 point increments, 0.25 increments, and the margin requirement is $5,000 for each contract. Now, sounds like a lot for a single contract. Each point on the S&P is going to be 4 times 1250 is $50. So you're going to have $50 per point of movement. Now that means the S&P would have to go up or down 100 points for $5,000 to kick in. Now that's what you have to know your history. That just doesn't happen very often. And you're not going to, the idea is you're not supposed to sit there like an idiot and watch it move 100 points against you. Today, we go from 2060 to 2080, so there's a 20-point move today. That's a pretty good-sized move. And how do you know what a big move is? Well, you go to a long-term chart like stock charts, which we should have somewhere. There it is. And you put up the S&P, SPX, and you look, and you say, well, how much does the S&P move in a day? Well, here's a chart. And 2140, here's 100 points, right? So how often does it move 100 points? Well, first of all, it never moves 100 points. These are days. So it never moves 100 points in a day. It does move almost 100 points in like a week or so. And certainly I see a day here. This is these blocks are what, 20 points each? So there's a 40-point day. That's a 40-point day. That's a 40-point day. So there you go. So if I was going to trade the S&P, I mean, it's not that it can't. By the way, don't say it can't. But realistically, if I'm trading the S&P, I'm thinking my risk is more like a 40-point move, not a 50-point, not a 100-point move. All right, and 40 points times $50 is $2,000. So my real risk from day to day is about $2,000. Now it could go 2,000 in my favor, it can go 2,000 against me. But that's my real risk, okay? The $5,000 is the broker's taking conservative margin to make sure you don't get completely screwed up. So they're going to take $5,000 in margin. Now, $5,000 in margin, and in general in the futures, we're thrilled if we make like $200, $300, $500. We're thrilled with like a move like that. So you think 5,000 margin might be kind of extreme, but it's only a day of margin. Usually when you're taking your margin and putting it aside, you're putting it aside for months, for years. This is a day. This is the time that you're holding the futures contract. It's the time you have the outstanding margin. So I'm going to say that. I'm going to pause here, even though we're at kind of good spots. I'm going to pause here briefly to just see if there's any questions, and then we'll go back. So hang on. Meeting burner. There. That thing. There you go. Chat. All right. We have V patterns and charts between 6 and noon. Was there some news that caused the stock drop and recovery today? I think that it's weird because after Europe closed, we kind of took off, and I think that there was some. I didn't see anything particular, but I think people are kind of relieved, and I think people think China's going to do some stuff. And I think the big thing, though, is that there's like rumors coming out from the Fed. You know, obviously you're not supposed to have any idea what they're saying, but that doesn't stop people from saying that they think they know what's going on. And over at the Fed, the thought is that this uncertainty in the markets internationally is making the Fed probably decide to pause and take longer to start easing, to start tightening, and therefore the free money continues to flow and everything is great. Wayne asked, are we still bullish on BHI? We just sent out an alert to our members saying we actually doubled down on our BHI position. So yes, to that. All right, cool. All right, so that's it for questions, so I will plow ahead. All right. First of all, trading the futures. Now, you have a bias from the news. In other words, the news made me think the market's going to go up or the market's going to go down. That's my bias. Now, remember this morning I said I think the markets will bounce 1%. So we're getting close to that 1% range, 0.7% on the Dow, 8.6% here. Now, I'm going to look at this chart. It'll be a little bit harder for you guys to see, but it shows more stuff. Let's get rid of this to make it bigger. So here we have the Dow, the S&P, the NASDAQ, the Russell, the Nikkei. Now, when you're doing this, you're just basically playing a game where one of these things is not like another. Is one of these guys lagging? These all generally move together. So is any one of them particularly ahead or particularly behind? And we can see here, you see these guys, these are your pivot points. And when you have a chart on Thinkorswim, it's called a study. When you do your chart thing, if you right-click on the chart and it says studies down here, and you say add a study, and it would be a trend study, and P down, C down at the bottom, P is pivot points. So that's the study that I'm on. And it's funny because when I say something before, I always feel weird saying it again, but I'll say it again. That's why I'm not a good teacher, because I don't like to do old stuff. Teachers are like actors; they kind of do the same show over and over again. But anyway, so when I do a study of almost any kind, I generally leave the standard things in because standard is what most people are using. I'm not doing a study for myself. I'm doing a study to see where most people are going to be making decisions. So I leave the standard bits in place. So I don't really even care what the adjustments are. I keep it where it is. Meanwhile, it's working because you can see we had resistance, resistance, and now we're breaking up to it. Resistance, resistance, breaking over it. Resistance, 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 resistance. So now what do we see? We see the Dow is over 17.5, which is a good line. It's getting over it's what you call a resistance 1 line. This is R1, R2, and S for resistance 1, resistance 2, S for support 1 and 2. These are called standard deviations. The further out they go, the more likely it is it's not going to make the break over that line. So the S&P is our most important index. It's got most, the value-wise, it's got most of the big stocks in it. They're already over standard deviation 1. That means I expect the other guys to start following. So if the S&P ticks up a little further, I'm going to expect the Russell, and I'm going to expect the Russell over here, and I'll expect the NASDAQ to move over their lines. Now, I can see visually that the Russell is almost at their standard deviation, but they're also at the 1220 line, which is a good spot to go long. The NASDAQ is going to hit 45.50, which is significant resistance. But see, they're going up now, and they're going up, so I'm going to do that. I'm going to play the Russell rather than talk about it. Let's just take a play on the Russell, which is TF. So I just change my thing to TF. This is how easy it is to do. Change my thing to TF. I click right here. Well, click right there. And I don't know if you hear that little sound. It makes a little sound when it fills. And now I'm long 1 Russell at 12260. Very, 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 very important point about these things. Generally, you don't want to enter a futures trade. You don't want to force a futures trade. So I am forcing things because we're doing a class. So if we're doing a class, if I'm not going to trade, what's the point? Ideally, I would have liked to have gone long here at 1200 because that's a fantastic support line. All right, but we weren't doing the class at 10:25, and I had to wait until we started the class. Also, ideally, I would have entered as soon as we broke over 1220, not waited until 1220.6. But I'm also going to show you scaling in, so we'll watch that. I'm watching the dollar. The dollar's not doing much, so I'm going to get off of that, and we're going to go take a look at the Dow. Let's look at we'll look at the Dow and NQ. So we're going to go YM is the Dow, and NQ is the NASDAQ. So I'm looking for all of these guys to confirm my premise, which is my premise is we're breaking higher and we're going to get over these lines. So now the Dow is over that standard deviation 1. The S&P is still there. The Russell is just catching up a bit, and the NASDAQ is catching up. But I think the NASDAQ is going to hit resistance at 45.50, but that's still 5 points. So if they're going to go up 5 points, I think the Russell will recover and hit at least this line, 1222. And on the Russell, that's like $200. You know, if I get up to that line, it's almost $200 in profit. So all I did was go long on one contract. For the Russell, the DB, the dashboard, shows me that a Russell contract is 50. Wow, these margins have gone up huge. These margins have gone up like 20-something% in the last week, which is usually a sign that the market's going to go sour, actually. Because the brokers are worried they're going to lose their money when you get your margin call, so they tend to ratchet up for margin requirements. So the Russell pays $10 per tenth of a point, which is $100 per point. So you better be right when you're betting the Russell. Oh, also it doesn't say it here, but the cost of a futures contract is generally, I think it's like $1.50 to in and out, so it's like $3 for a round trip on a futures contract. So it's sort of insignificant. The cost of the contract compared to the movement of the contract is fairly insignificant, which is wonderful because it means you can quickly, you should quickly take your profits because it's not about, there's no friction cost to doing the trade. All right, so you can quickly have a premise, see something happening, react to it, and make some money, and then get right out. All right, you don't have to sit there and leave it. It's not an options trade. It's something I say, here you go. We already made $50. Here's lunch, right? $60, $70. So now I'm going to put a stop at $50. Ah, look at that. It fell down already. So now you see it jumped up to 70. I was too greedy. And now I'm waiting to see what happens. But meanwhile, now I'm going to look to confirm. Did this guy fail? No. Did he fail? No. He's still going, and he's still going. So I'm going to ignore that little drop for now. But maybe the Russell's going to lead us lower. I'm not paying attention to the news. I should be at the same time to see if anything changes, of course. One of the problems with doing it live like this is I can't hear the TV. So I don't know what's going on in case anything news breaking or something like that happens. Now everybody's weakening a bit, so it's a little disappointing, but I'm going to take my $10 because my premise is gone. Oh, didn't fill. How nice. That could happen too. My profit just evaporated. Oh, there it goes. No, see, I held firm. So now I made $10. I didn't make $10, so there's a $3 probably ticket charge. So I made $7. I could have made 70, but I didn't grab it in time. And I remember I was saying we could have stopped at 50. All this is like things that you have to learn, and obviously when I'm doing a demonstration, it's hard to talk and do and whatever all at the same time. But you've got to do that. You've got to be happy. You made $70 in 10 minutes. Set your stop and say, great, okay, $70, that's lunch, right? So now we want to see what's happening, but I also want to check my news and see if anything occurred. Did anything make us stop here? Or again, my original in the morning, I said we're going to go up that 1%. We are hitting that 1% line on the S&P, and if they're stopping at 1% and everybody else is getting close to 1%, this is not unexpected. And I'm not necessarily going to short, but let's find out what's going on to take an idea. So let's look at something like let's look at Seeking Alpha. Oops. So Seeking Alpha has a nice news thing. It's one of the best things on Seeking Alpha. News. And here's how I do the news. I do all news, and I don't like it because if you leave it on latest, it scrolls, which I guess some people would like, but that's, I guess, that, since I use a bunch of screens, I like to just know where I left off. So I do today so far, and that gives you all the news for the day and static, so you have to refresh it when you want to see more stuff. So let's see what's been happening in the last half hour, though. Radware down 11%, don't care. Oil sands pipeline projects placed in doubt, okay. Now that's a Nexon spill. That's not just in doubt as usual. Nexon spill, 2 big football fields. Oh, God, what a mess. 31,000, yeah. All right, well, that's just, all right, so in my mind, I just put a negative check next to oil. This is what the people are protesting outside the White House, and all the conservatives, like, oh, those liberal wackos, It's like, no, this is what happens when you have oil pipelines. They spill and they destroy land. So, you have this oil pipeline going through your town, and all of a sudden you have this great big black pitch flooding your football fields and stuff. It's not good. Cholesterol thing and good. Oh, that's very good. Wait. Cholesterol fight is successful in a mid-stage study, and they're down 2.9%. That's odd. Seems like a good thing. Don't care about that. GT Advance. We like GT Advance. Obtains a 91,000 debtor in session. They obtain. Okay. We're stuck with a lot of GT Advance, so we care. Fund working capital, they're kind of bankrupt. Includes some convertible notes. Apple previously raised objections to their efforts to obtain the financing. Oh my God. What a mess. Okay, so same old message. This obviously has zero effect on the broad market, though. Dominion, Panhandle, there's nothing here that would move the markets. Super value. Now, not that seeking alpha, of course, is perfect. That's why I like to, the only reason I listen to CNBC, I can't stand them. They're like nails on a chalkboard to me. But the only good thing about them is they do break news, and they break news better than Bloomberg. Because Bloomberg, if they're doing a piece, they won't interrupt their piece for news. They don't consider that important. Well, they scroll it, but it doesn't give you a verbal thing. CNBC will interrupt anything if there's news breaking and talk about it, which is good because I have an ear. It's easier to keep an ear open than an eye open. JetBlue's earnings call was good. Freeport has a plan to cut output. Now that's helping all the commodities, because if Freeport's cutting output, that's a good sign. They're going to have some restraint, and they'll raise the prices and blah, blah, blah. But don't forget, that's what boosted oil for a while when people thought they were going to cut back, and it didn't actually work out. This is huge. Intel and Micron have a new 3D memory, which is going to be a huge increase in capacity. Caterpillar jumps on their buyback promise. Very nice. We have some of that. BlackBerry, God, we even thought they were alive. All right, anyway, so now we're all the way back to 1145, so we're good. So there's nothing here that I see that would have changed the market, and look what happened. Now we're back up again. Now we zoom in, 1284. Can I get back in? Sure I can. I don't have to, just because I got out doesn't mean I can't get back in. I would have liked to have, had I caught us going back over 1220 after that little dip, I would have been more inclined, because now I'm kind of not happy about missing a point. So who's the laggard now, though? That's the question. The NASDAQ has to get through that 4550 line, which is a little tricky for them. See, 4550 is not only resistance, but it's also, the 4550 line is also their resistance line. It's going to be very hard for the NASDAQ to get over that. So I'm hesitant because of the NASDAQ. So let's go back to the bigger chart and see if there's any other opportunities. We're going to go trade, charts. All right. Another clue you want to look for is what's the dollar doing? If the dollar's going down, which it is, that helps the market go up. So the dollar fell from 97.25, which is down 0, not for the day, but from the high, down from here. It's down 0.25%. That allows these to go up 0.25% because, a stock certificate is like a commodity. It's a thing that's priced in dollars, right? So if the dollar becomes less valuable, you need more dollars to buy your stock certificate. It's very simple. And that's why the stocks move against the dollar. If the dollar goes down, stocks go up. Dollar goes up, stocks go down because you need less dollars to buy your stock certificate. So the dollar is a thing of value that you're trading for a stock certificate, which is another thing of value. And that's why you have that relationship. Speaking of things of value, here's some gold. Now, if the dollar is breaking down seriously, then you're going to expect gold to go up and silver to go up and oil to go up. Here's oil, which is testing the 48 line. Now, that's interesting because you want to think about oil. Oil, though, see how oil here is up 1.43% for the day? This is Brent, and actually I'm going to change that to BZ. BZ is also Brent, but it's a live contract. Brent is up only 0.11% for the day. So our oil is way ahead of Brent, and that doesn't make me trust this move. But you see how Brent failed at support 1, came back to neutral. We are still over support 1, but if we fail 48, we may come back to neutral too. I don't want to bet oil down because I don't have any particularly good reason to it, but this chart indicates it's not a very safe bet to bet it up right now either. We have natural gas, we have gasoline over here. Gasoline's floundering but trying to hold 180. Look at the VIX. Holy crap. I mean, it went up and up and up, and now it fell off a cliff today, and it's way back down. So this is what you call complacency. Nobody's worried about the markets going down or anything else. I don't know why eBay's there. That's interesting. I don't remember looking at eBay. Here's Apple. That's a lot more important to watch. All right, so treasuries are just moving along there. There's nothing exciting going on here, but if 97.65, if 96.75 breaks on the dollar, that could be a catalyst that sends things higher. And already, see, look at the S&P over 2085. So there's a positive sign. The NASDAQ is just going to test 49.50. Once they get over 49.50, they got a clear shot up from there. But we need to see the S&P get over. That's a tough line. 2085 is a tough line. It was yesterday's midpoint. Yesterday's neutral was 2085. That's a big significant line for the S&P. I don't think it's going to make it, frankly, because you're also now you're hitting this resistance on the Russell. 40.50, 45.50 is a tough line on the NASDAQ. And the Dow's over, but the Dow is a stupid index. You really can't go by what the Dow's doing. The thing about the Dow is there's only 30 companies that determine its movement. And even the smallest company in the Dow, which is probably Alcoa, value-wise, even the smallest company in the Dow, if it moves 10 cents, has the same effect as if IBM, which is 10 times more expensive than Alcoa, moves 10 cents. Doesn't make a difference whether IBM does it or Alcoa does it. It's the same movement on the Dow. That's a stupid way to run an index. It's called a price-weighted index, and it's very, very dumb. Most indexes are weighted by market cap, but not the Dow. The Dow runs based on any stock that moves any amount, affects the Dow the same way. It makes it very useless as an indicator, but still it follows the other indexes, just because computers don't care. Computers don't care that it's stupid. They'll just buy it anyway. All right, so we'll go back to some questions now since I don't see any particularly good trades. Oh, good point about the futures, though. I say this to my members all the time. 9 out of 10 times you look for a setup in the futures, you should do nothing. If you're not rejecting 9 out of 10 setups that you see, you're trading too much. It's like you need to look at, you're looking for a reason not to trade. You might have a premise, but you're always looking for what might break your premise and what might make it off, because there's thousands of chances to trade the futures. Any time you look, you could trade the futures, but most of the time you shouldn't. But when you see a great setup and you've got great confirmations across the board, that's when you want to make a trade. All right, so like here, if the dollar's failing here and gold goes up, especially if gold gets close to 1100 and silver is still over here at about, at 1464, then I'd want to bet silver at least for a little move up to this line at 1470. And that doesn't seem like much, but silver is a very expensive contract. It's $50 per penny. So if I get a 6-cent move out of silver, that's going to be $300. All right, so I'd love to see that setup, but what do I want to see? I need to see the dollar below 96.75. I need to see gold getting up, let's say, over 109.750, and then I want to bet silver over 1465. Oil, like I said, though, I think we're coming close to the NYMEX closes at 230, so we want to see, I think we're going to see a bit of a sell-off in oil into the NYMEX close. And if we are seeing that, then that doesn't bode well for other commodities. So again, I don't have a great reason now to play. I want to play silver long, but I just can't get fully behind it at this exact moment. All right, so I default back to don't play, and let's see what happens next. I only get smarter, right? I only learn more things as time goes by. So there's nothing wrong with not playing and waiting to get some information. All right, back to questions. Okay. Oh, Craig says, Brent has been down all day and is even now. WTI is up. Do you think maybe there's a short here? Okay, so there you go. I was talking about that. Yeah, I think it's a short. I think it's going to sell off into the close, but no particular reason, only because I think it'll kind of, line itself back up with Brent a little bit, and it may be that we went up a little too much, but, there's no, I don't have, I want to have at least 3 good reasons to do something, not 1. And so just saying that Brent should line up with WTI, it's a good reason, but I can't really get behind doing a trade on it, especially because that 48 line is tough, and also I'm generally bullish on oil. I think Brent is wrong. I don't think WTI is wrong. I think Brent is wrong. I think they're way too conservative. Now, what's happening is because Brent, and for some reason we have a much longer view on Brent than we do on WTI. That's weird. For some reason, Brent is, what am I trying to say? They're much more affected by Iran opening up, because Iran is Brent oil. Iran goes straight to the Middle, the Middle East goes right across the river to Europe, and the sea or whatever goes right across the sea to Europe, and there's your Iran oil. So they're right in that market. So it's Iran oil. It's like local oil. Okay, it's like as if Iran were in let's say in Central America, okay, and they started dumping a couple of million extra barrels of oil into our market, then we would be affected much more than Europe, right? Well, that's the same thing that's going on now. Iran is basically in Europe, not too far, and the Iran oil situation is affecting Brent much more than us. So we're going down with Brent in sympathy, but it's all about the Iran situation. And here you go. So now oil is breaking down a little bit here. As I said, for the next hour, I think there'll be pressure on it to go down a bit lower. But then we have our, I would actually almost want to go long into tomorrow, because we have the API report, which I think won't be that bad. I don't think it's going to justify this kind of drop that we've had. So, all right, let's take a minute to talk about that. So, as I said, you see how I didn't want to play these long, and they're not going any higher. Let's talk about that for a second. Okay, here you go. WTIC, right? Okay. So in the last month, a lot of this is based on the peace with Iran thing. We've come down from 58 to 48. That is a big drop. That's like 20% drop in oil. We're getting close to that spike bottom. It didn't last. Okay, just because oil was $42 back in March. It only lasted a week. This is I'm sorry, this isn't a week, this is a day. It only lasted a day. All right? That's how long it was at 42.41. So it says 42.41 here. Do you see that little tail? That's what it looked like during the week. The whole week it was up here. Here's where the week was. For one day it was down there. So the real bottom is 44. And in fact, yesterday in chat, we just talked about that. Isn't that funny? Nope, that's Tuesday. Damn. All right, well, take my word for it. So yesterday in chat, we just talked about that exact number. It was 44. And I said, let's see if I remember this correctly. Oh, yes, the dollar was stronger. The dollar was at 100. When this happened, the dollar was at 100. All right, let's take a look. Well, I can do this visually. I don't have to just say it. Oh, look at that. It's right there. Okay. Hello. There we go. All right. So at the time, in March, the dollar was spiking to 100. That then put pressure on oil and dropped it down. The dollar only spiked up and came back down. So oil spiked down and came back up because oil is priced in dollars. This is not complicated. All right. So basically, this had nothing to do with oil's value. This is oil's price in dollars. Had nothing to do with oil's value. Oil's value held around here. And I think I calculated yesterday that we're 40. If you factor in the drop of the dollar of 3.5%, let's see if I can get my little calculator. Okay, and we take 44 times 1.035, which is how much the dollar has gone down, and we add that. Since the dollar is less valuable now, you should get more dollars for your oil. And that takes us to 45.54, okay? So basically right around 46, and you see how that 46 line was pretty strong here? So around here is a fair price for oil. I'm sorry, not the fair price, the fair bottom. 45.54 is as low as oil should go, even as it spikes down, as long as the dollar is down here, where it is now. So what we're going to look for is for 46-ish to hold, and we're going to get a little bit aggressively long here on oil. And I think we already did do a USO spread. Let me take a look at our short-term portfolio, which has come back really nicely. Although today I better pull back a bit. We got totally, we got killed on the Netflix trade. Oh, yes, it's up 125%. That's pretty good. All right. I think we did a USO spread, didn't we? We did SCO. We sold the SCO calls. SCO is an ultra short on oil, so it goes up when oil goes down. We sold the calls. We got burnt so far for $12,000, but I don't mind that because oil will not stay this low. So that's for us. This is a long position on oil by shorting the ultra short ETF. Very complicated, but you know what? You get a hell of a lot of premium for these things, so it's worth it. Just because it makes your head hurt doesn't mean you shouldn't do it. USO, we did not do USO. Oh, we did UCO. That's what we did. So we took this UCO spread last week, and we were early. But what we did is we sold the September 25 puts, which is ridiculous. That's like $25 on UCO is like $40 oil. So we sold the September 25 puts. We collected $3,300. We then bought the 30-33 spread. Now that's quite a bit higher than it is now, and we probably should roll this. We haven't made that decision yet. Did we? I don't think we did. We might want to roll this as we get to our low point. But we've got the 30-33 spread. If I were doing this now, I'd do a different one. I'll show you in a minute. But that was only $1.50 or $1.45. Okay, so that was a cheap spread, and we paid for it by selling these calls. The net on this was only 35 cents. All right, so we're very happy with this spread, and if oil comes back just a bit, we're going to make a huge amount of money. In fact, we're going to make 30 times 3 is $9,000. There's almost $9,000 of profit in this spread if it kicks off right. I would not, as a new spread, do this, because as a new spread, I'll show you what you can do. So UCO is ultra long oil. We're not supposed to be doing this, so we're supposed to be doing the futures. But UCO is ultra long oil. We're playing for the Labor Day holiday. That's our premise. It's going to go up in Labor Day. Right now, you can sell these 25 puts, which I still think is a good strike, for $160. It's going to be between $150 and $170. It's you bidding your ass, so certainly you can get $160. Somebody just got $165 for it. And you can pair that with the, well, here you go. You can take these 26 calls, 455, 20. All right, well, see the difference is 70, so then 35 would be 485. So take a 485, 490 is what you're going to spend for those. These are the 26 calls. And then you would sell 490. We want to collect at least 290. So let's say we sell these 30 calls for about 290, and now you got a $4 spread for roughly $2. So the 26-30 bull call spread. They're at $29 now. So all oil would have to do is go up a little bit. So you're saying $2 for this, and you're collecting 155 here, and that's net of 45 cents. So for 45 cents, you have a $4 spread, the 26-30 spread. And it's already $2.89 in the money. Okay, so your 45 cents can turn into $4. But it's already 289. I mean, you can't cash it that because of the premiums. But if it stays right where it is now, if oil stays at this price, 40, whatever the hell it is, $48, you get 289 back on your 45 cents. I mean, that's how you play oil long. It's a great way to play. All right, so I'll do an option seminar some other time. That's what we do pretty much. We do that every other week, so we won't talk about that now. But those are very simple option plays that you can make to make a huge amount of money. Meanwhile, though, okay, look, 48's holding up pretty well. I wish it was 47. If it was 47, I would go long for sure. 47 is just way too low. But 48, I could see it dropping, and I want to see what happens into that close at 230. Got lots of time, so no hurry. The dollar's holding up, so no worries there. All the indexes seem to have gotten tired around this spot, so we'll see what happens. Questions, that's where I was. Okay. Yeah. See, when you're an actual teacher, then you have people sitting there, and you remember they're asking questions. All right, so there's the answer for Brent. Would you sell the ABX? Start with the options questions. Would you sell the ABX $8 in the money puts for 240? Yes, I would. We just pressed our bets on ABX. How about Gold Corp? I like ABX better than Gold Corp. So, I mean, I would pick one or the other, Wayne, because ABX is they're both good. They're both the top two gold companies. But gold is in a world of pain, and I would just pick one because you're probably going to have to watch it and adjust it and change it. So, decide which one you're more comfortable with and choose that. And then you have to make really firm decisions. You have to say, I'm going to stick with this thing through thick and thin, because you're probably going to get banged around quite a bit more. Craig says FXI is up today. Wasn't China down? I think we talked about that, right? FXI is up. Because they finally said, you know what, maybe we should kind of stop producing so much copper because it's not selling. Once you do that, once people decide to do that, that helps the supply situation and prices can go up. We like FXI a lot, though, over the long term. And again, don't we have any futures questions, guys? Yes, Chrissy, I'm recording. Thank you. And the things are trending, yeah. All right, yeah, Joe. He's noting that the indexes are trending lower, but TF is trending up. They don't always move the same way, but I like to use that. I talked about it today. Think about it like tugboats, okay? So, how do I do this? Oh, I know. I can do visuals. Look at this. Isn't that cool? What do you? Okay. Tugboats. That's interesting. I never thought about doing this. Images of tugboats. I will have a visual example for you. Hopefully. Oh, you think you can get one view from the top? Oh, come on. This isn't that complicated. There's two boats. I have this great idea, but then I'm trying to find a picture, and I'm like, oh, nobody has a picture of like a boat being towed? I was thinking a big boat, not a little boat. Okay, well, I guess the first example was as good as any. So I hope, generally you guys are familiar with the concept of tugboats, but, so here you go, okay. Well, that's a bunch of tugboats, but you can't see the thing that they're tugging. What I'm thinking of is you have a great big ship like this, okay? So here's your big giant ship that has to be towed, okay? Or this thing. See this oil tanker that's being, here you go, 1, 2, 3, right? The tugboats all have ropes and they attach to the big ship, okay? And they all pull, and they're all generally going in the same direction, all right? Like, see, all these guys are all going in the same direction, pulling somebody way back there. So one boat may go up a bit ahead, and one boat may go off to the left a little bit, right? But in general, they're all tied to the battleship. So they can't go. There's a limit to their ropes. He can only go this far ahead. This guy can only go this far ahead. He can pull back and get slack, but he can't exceed his limit away from the big boat that he's tied to. He also can't go too far this way because he'll hit the limit of his rope. And this guy, and also if all these guys are pulling this way, right? If 4 of them are pulling this way, and the boat starts going this way, then he's going to get pulled that way whether he likes it or not, because the weight of the boat and the other ships is much more than his. That's what I mean by a tugboat example. So now, hopefully that was clear enough, and now we take that image and we think about how that affects the indexes. All right? So, consider the S&P to be your battleship. Okay, that's the big heavyweight index, and more so actually the NYSE. But unfortunately, there are no NYSE futures. But if you want to really get it, the NYSE is essentially the whole market. Everything in the S&P is in the NYSE too. All these stocks are in the NYSE. So the NYSE is the real battleship, because that's just everything, all in the exchanges. Or most everything, anyway. Some things are exclusively to one exchange. So the S&P is just an index of the top 500 stocks, but it's not necessarily, they're not, it's not itself a thing. The NASDAQ actually holds things, but the NYSE, things in the NYSE are included here, things in the NASDAQ are included here. The Dow is the same thing. The Dow is just an index. The Dow is not an exchange. So these are made up of components of the NASDAQ or the NYSE, and the Russell too. The Russell is just 2,000 small cap stocks from the NYSE. The Russell itself is not an exchange. All right, so these guys are your tugboats, and you look at the S&P, and you look at the NASDAQ. I wouldn't count as a thing. The NASDAQ though is going to follow these guys. But these are your tugboats, and they're going to go off one way or the other. And one can go one way, and they can all go the other way. But the reality is, there's only so far away the Russell's going to go before it snaps back. So what Zhao was seeing was that these guys might have been heading up, while we had a little correction here in the NASDAQ, and let's zoom in on that. See this little pullback here? Okay? But it didn't last long, right? Because the other guys snapped it back up. As they started moving up, see, he never really went down. He just kept going up. Okay, he never went down. He kept moving up. That's the Dow. So they snapped the NASDAQ, they snapped the Russell up. It had to join them. It didn't have a choice. There's only so long it's going to be able to fight the other ships. So that's what I mean when we talk about a tugboat example. They all are going to get themselves in line. Of course, it doesn't mean they're not linked together, but they certainly can't deviate too far from each other. The NASDAQ actually is the one that can most deviate because it's not the same stocks as the other NYSE stocks. But also, though, the NASDAQ has a weird weighting. Like the Dow, the NASDAQ has a weird weighting because it's made up of Apple, essentially. So the NASDAQ is essentially Apple and some other stuff, but mostly Apple. The Apple has a 15 to 20% weighting in the NASDAQ. So anything Apple does immediately will affect the NASDAQ. So at the moment, Apple is kind of flat and not helping the NASDAQ, but also not hindering the NASDAQ. So it's drifting along. If Apple starts moving up, I would certainly want to be long on the NASDAQ in that case. All right. So that's a very big part of futures trading. Those you're looking now. The battleship is heading this way. It's moving forward. The tugboats are behind the battleship right now. They're losing ground. That's not going to last long. If the S&P kept going higher, these guys are going to start moving up. But what's actually happening, though, imagine the tugboats are pulling the ship forward, right? But now the tugboats stop. They don't want to go any further forward, and they start pulling back a little bit, right? What happens to the boat, the battleship? Well, the battleship's going to keep going forward because it's got momentum until it starts feeling the pull from the other boats. So in this particular case, the S&P got a sort of like a nice move, and it just kept going on its momentum. And what does that mean? People are buying blue chips. So a lot of people want to buy blue chips. And so if the market's going up, they might not want to jump into Netflix or something like that, or Priceline or whatever, but they sure as heck do want to buy GE and whatever. And that's what we're doing. In fact, we were just reviewing our long-term portfolio in member chat here. Let's see. It's amazing how relevant the stuff we do is, right? This isn't our membership. Oh, that's last week. Holy cow. Okay. There it is. It was funny. Last week we were at 2130. We were talking. We were saying how we were shorting everything at 2130, and look what happened since, right? We had here. Look, we were at the top here. That was a good article, man. Look at that. We were right there, and now we're down here. That was a good call. Anyway, where is that? Here we go. Here's the long-term portfolio. This is only part of it. These are our spreads. And we talked about things like ABX, BHI. We doubled down on BHI. I mentioned that. CCJ, CLF, Encana down here. We added to Encana. We improved DBA, which is the agriculture ETF. We repositioned coffee, but we didn't really spend much money doing it. Got a whole bunch more to go through after the webinar, too. So blue chips, I'm sorry, yeah. So the ones I mostly want to add to, and let's see what we do have here. We have, iRobot, we just talked about that. We have Lumber Liquidators, still in our portfolio. We have Lululemon, Mattel, Manitoba, who just got downgraded, but we like them. So we're going to be adding there. Here's Mila. We got screwed on them because their buyout deal fell through. We're going to have to reposition that one. Here's OIH, which is the oil services. Here's RIG, which is an oil service stock. Here's Silver Wheaton, also in the crapper, and we're going to certainly be moving on that one. We have Taser, one of our favorite stocks of all time, and Time Warner. And look at Time Warner. Time Warner's killing. Look at that. Holy cow. See, this is interesting because the 155 calls are up. Oh, I see. So we're showing a huge loss on. Oh, it's because it went way up. We're showing a huge loss on these puts. That's silly because we're going to make the money on our spread. This one's in the money. Anyway, all right. So we definitely get excited about adding to the blue chips. All right, and that's what people are doing now, though. So when the market's bottoming, I want to grab those S&P stocks if they start going up because I certainly want to buy Boeing on sale, IBM on sale, GE on sale. Those are exciting things to buy on sale. It's not that exciting to buy like Netflix on sale or Green Mountain Coffee on sale because they're so freaking expensive anyway. That's not a bargain. That's just like a little bit less than crazy expensive. So as we expected, 2085 is a tough thing for the S&P to get over. But we're not seeing any kind of major rejections from the other guys. And this is why I didn't want to go long before. 45.50, tough line to cross the Nasdaq. 2085, tough line for the S&P. 17,550 is going to be tough on the Dow, and 1225 is going to be hard. Well, 12250 is going to be hard on the Russell. All these are tough lines. It's not a negative though because they're pausing at their resistance line. That's not a negative. That could be a very big positive. That could be they're consolidating for a move even higher. And keep in mind, we're looking at a very, very small perspective here because, because in reality, this is nothing. Big chart. Oh, right at the top of our post. Okay. Yeah. If we look at the big chart, which Jean-Luc is very kind to help us with every day. Image in new tab. There you go. That should make it big. There we go. Look at that. If you look at the big chart, we've fallen from 2130, a double top. Remember we called this top last Tuesday right here, 2130 Tuesday. 5th time's a charm? No, it's not. And they look toppy and weak, and I listed where we were toppy and weak and what we liked for shorts over here. So essentially exactly what we said, 2130 on the dot, we poked over it, and then we collapsed. And then we collapsed all the way back to the 200-day moving average. All right, which to me indicates what complete bullshit 2130 is. But now we bounced off that. So if you look at this drop, what's the 5% rule? 2130 to where was yesterday's close? 2068. If you want to do, you can use the 5% rule this way because basically you do an exact calculation so you can figure out the intraday bounce. And let's see, without looking, let's see what happens. So we go 2130 minus where was yesterday's close? 2068. 2068 is 62. 62 times 0.2 20% bounce is 12.4 plus 2068 equals 2080. That's a weak bounce. All right, so the 2080 line, look how convenient that is. It's right there. It's a something. What is that? It's probably not 12 point. Is it 12.5%? No, 17.5%. So it's like some line anyway. I think it might be the 17.5% line. It's so far up there, it's hard to even say what it is. But 2080 is a very significant line, obviously, and that's what you call the weak bounce. So for this thing to bounce, we expect to bounce to at least 2080. Otherwise, it's a failure, and you're going to continue down. And if we do fail and continue down, then what's going to happen? You're going to get one of those triangle squeezy patterns, right? Because you're going to bounce up and back to the 200 and back up into the 200 and just like that. And it makes a little triangle wedge. And then when it resolves itself, that's when you're going to get your big move. And probably our big move is going to be this. All right, so I'm still expecting a bigger correction than what we have here. So, you know, obviously you're going to bounce off a major line like the 200-day moving average. We went a bit below it. We came ripping back up. But why did we come ripping back up? We came ripping back up on low volume and on China stimulus, that BS China stimulus that didn't actually fix anything, and on Greece being fixed, another nonsense, ridiculous thing where all we did was kick the can down the road. All right, all these things lead me to stay bearish on the S&P, but today we expected a 1% bounce. Very simple, and I wrote it right here. I said bouncing back to bullish was the question, and we talked about it, and I said right here, we expect to bounce to the 3% line and 1% bounce where the real test will be. These are the bounces we'll be watching for, and here we calculated 206, well, oh, I'm sorry, I was too conservative here because we never completed the 5% drop, so I shouldn't have been that conservative really in those numbers. Well, like I think so if you do the calculation off, then we're back to 2080 off of this. Had we done the full correction, then 2060 would be the critical line, but we're bouncing off what would be the strong bounce line. But the easy way to calculate is take the drop. Okay, so we took the drop of 2130 minus where the drop ends, which is 2068. And then that's 62 points. You multiply that by 0.2 is your weak bounce. And that's 12.4. Add it back to the 2068 with the bottom. And it's 2080. That's how you calculate what your bounce should be. Now, you can always do this in the futures, and it always covers any period you're looking at, but you have to find a consolidation. The idea is to find a consolidation point to a consolidation point. So now we're finally kicking over, right? So the Dow's getting over, these guys are getting over 1222, and once the Russell's over 1222, we can go long again, 1222.5 anyway. So now we have a reason to be bullish. The dollar is still staying where it is. Oil hasn't gone down. That's going to help. Oh, by the way, it's another thing. Oil staying down. The energy is a big sector. You know, it's so material. So you don't want to see like copper and oil and things falling off too much. Where's copper? I don't know if I have all those charts up on this one. Sorry. No, I don't. All right. It's my other screens that you can't see. Anyway, so I'll tell you what copper is. Copper is listen. There it is. Whoa, copper's having a good day. Copper's up 2.5%, 240. All right, so copper's coming ripping back thanks to FCX. That's going to help the material sector. That means so now we say, okay, the material sector is coming back a bit. The oil sector is coming back a bit because oil had a decent day. And then how's XLF doing? All right, so let's expand this a little bit for a second. XLF is the financials, right? XLF. And XLF is coming back. So obviously there's no reason for the S&P to be down. You know, all its sectors are doing well. Oh, and in the bottom of PhilStockWorld we have that too. We have that little sector box. Let's see. Gotta refresh my page. So here, we weren't calculating the intraday bounce lines. I was talking about we need a 1% bounce on everybody, but the bounce lines that we were watching were off the 5% lines, which are very important, but that's on the bigger picture. That's not the intraday picture. So here's our sectors. Oh, look at all that. Oil and energy, wow, 2.7% is huge. Basic materials, 2.5% huge. Transportation, up. So financials are actually a drag, but everybody's positive, very good stuff. So why would the S&P be down if everything's doing so good? And the answer is it wouldn't, and it's not. All right, next. Nope. Robert says, TF bump to R1, would you short TF there? No, I wouldn't short because we don't have a shorting premise. We don't have a good reason to short. So I'm sorry I don't have, like, I want to do more examples of the futures, but I also don't want to, like, just throw money out the window. You have to have a good reason to make your pick. And actually, I would like to teach this concept, though. Most of the time you look at the futures, don't play. Only when you have a really, really good setup that you can't imagine how you can lose. Because even then, even when you have a perfect setup and you can't see how you could possibly lose, you're still going to lose about 40% of the time. But you know what? If you win 60% of the time and you manage your money properly, you will make a fortune in the futures. Let's see. Todd says, don't know if you covered it or not, but how do you see gold going? Okay, let's talk about gold. Do you like SLB? Yes, we like SLB. But SLB's buying, no, I'm sorry, SLB's not. Halliburton's buying Baker Hughes, so I love Baker Hughes where it is right now, because Halliburton's buying them. SLB, I like all those guys, though. You can play OIH and hedge your bets, because OIH is also a really good deal right now. Why are the markets up so much today? They're not up, they're just bouncing, Chrissy. That's what we're talking about. And TF I answered? Oh, isn't that fantastic? Okay. I'm so glad I answered that, because I didn't know what I was saying. I'm sure what I would say now. So as you can see, though, we're not getting stupendous performance. A little poke above, I don't jump in and play. I want to see some confirmation. I want to see my 12250 here. I do have 4550. I do have 285. I do almost have my 17550. So my two laggards, we talk about going long or short the laggards. So when three guys do something that you expect, then take the fourth guy. Wait for three guys to confirm for you and take the fourth one, because hopefully that one will follow the others along. That's a wonderful way to play the futures. If you can find four good points like this that are all good resistance and you get through it, then all you got to do is go long with a very tight stop, and then you let the thing play out. But we're not, though. What's happening while I'm talking to you guys, and I'm sorry it's not working out better, but what's happening is we're not getting the confirmation we want. And so we haven't played, and frankly, that's good, because we would have lost money, or we'd be sitting here just staring at it. It's another thing, by the way. It's a good point. When you're trading the futures, you got to commit. You cannot go to the bathroom. Okay, you cannot answer the phone. You cannot chat with people. You can lose $1,000 in a minute playing the futures. If you're not paying attention, you will get burned. All right, these are, like I said, the Russell contracts. Every point on the Russell is $100. So this move right here from 1198 to 12 whatever, that is a $1,000 move from 9:50 from 10 o'clock until 12. So in 2 hours, it had a $1,000 move. All right, now obviously, literally not going to bed, but that's with one contract. If you have several contracts, then you're talking about multiplying that by a huge amount. So you really, when you're playing the futures, you have to take it very, very deadly serious. It's a very big thing. But like I said, though, even that, if you have one contract, this is extreme, but it's a $1,000 move. That's what you're risking when you do this. It would be foolish, though, to walk away and let that happen to you. Your discipline really has to be, I got to watch this, and I got to make sure that things are going the way they're supposed to go. Very, 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 very rarely do we play overnights on the futures. Now, we're going to talk about gold a little bit. All right, gold is, first of all, very dollar dependent. All right, so meanwhile, these are not shaping up well. Oil, closing, still waiting for 230, but it is struggling to hold that line. All right, Brent is done. It's not really moving anymore. It's kind of dead because nobody's trading it. But our oil, now fortunately they have support here, a little bit of support. It's not a support line, it's a resistance line, but still, once you're over them, they act as slight support. So it seems like we're probably going to trickle through over here, and then depending on the API report, we're going to get, the API report comes out after the bell, maybe about 5 o'clock or so. Depending on what that report indicates, you'll probably get a move of maybe 50 cents in oil one way or the other, depending on what that report shows. Logically, we're post-holiday, end of July, vacation time and all that, though. I think probably you'll see a decent demand for gasoline, no specifically huge demand for oil, and it'll probably be, I don't think you're going to get a lot of movement out of it, but you may get, if it's in any way a build in oil, you're probably going to come back to 47.50. All right, but then I'd want to go long. 47.50, I'd want to be long again. That's why I start getting interested in being long. Right now, it's kind of in between. It can easily go up or down 50 cents, which doesn't make it a very exciting bet. I like to have a better idea. Now these are getting good. Now we've got over 285 is clearly taken here. 545, 45.54, 1225. Remember, we were looking at 1225? So it's getting to the point where you kind of want to bet it. I'd love to see the Dow get over. Really what I should say is whoever gets over their line, 1225 or 1755, 17,550, whoever gets over their line first, we should bet the other one long. All right, so actually we can do that on the closer chart, which will be easier for you guys to see, I think. We'll go to active trader now. So in other words, we're pulling for the Dow to get over 17,550 or the Russell to get over 12250, and it is. So now I want to go long on the Dow. All right, but first I want to just confirm that the Russell is holding that line. It's not, it's just touching it. I really would like to see one of them get over their line. And this is what you do in the futures, by the way. You know, I know the members, see, my members are very spoiled because what happens is I do this and I wait and wait and wait, and then I make an announcement that says, oh, I think I see a good trade. So they only get the part where I say, I think I see a good trade. They don't get all the tedious waiting. Oh, there we go. Both of them just plowed over. So let's go long on the Dow, and I'm not filling. Oh, there it goes. Okay. So now we're long at 17,554. We missed our ideal entry. Okay. And all I'm going to do now is I'm going to watch to make sure everybody's making progress. So you have 725, 2.6, 45.8. See this resistance up here? I really would like to see that get over. Now, that's the NASDAQ. So if I want to know what's happening on the NASDAQ, let's look at Apple. See, all these little tricks you have to know. It's like the Apple runs the NASDAQ. So let's see where the Apple's doing. I think Apple's going to pick up. Now the Dow is a 42.90 contract. All these contracts are so expensive, and they're $5 per tick. So every point in the Dow is $5. It's actually, if you want to get started in futures trading, the Dow is probably the best one to trade. It's only $5 per tick, and generally they're going to not move more than like about 100 ticks in a chunk. So usually you got plenty of time to stop out before you get severe damage. Why is Apple not showing up on this chart? That's weird. Oh, because I did it wrong. AAPL. If you do it right, it works. So now we see Apple is making progress, and if Apple's happy, the NASDAQ's happy. And if the NASDAQ's happy, everybody else should be happy. But now we're hitting significant resistance. We still have this, we're not really getting over the hump on TS. I need to see that not fail here, otherwise I'm going to take my money and run on the Dow. So 226 is progress. 7.5, I want to get up there, and I want to see this guy make a little bit better progress than he's making now. I want to get him over this line. Once he's over that line, I feel a lot more relaxed about my trade. All right, and if you even feel like once you make some money, if you even feel that you might not make it, just get out. Oh, as I was saying that. All right, so 224, we're failing. But that's another thing, though, by the way. So it's not going to be catastrophic if we get out. Oh, here we go. The 60 line is going to be a big deal. If we cross that, that's going to be very good. Come on, 60. So we're already long. And we're up 15, 20. But I'm not sure we're going to make that 60 line. If we get rejected here, it could pull the other guys back down. In fact, let's say that. Let's do this. We'll take this money, because it's always nice to have some money. There you go, 15 bucks from the bank. And I know that's not exciting, but I'm just showing you examples. There's 10 bucks there, 15 bucks there. Now we're going to go long on the Russell, and if it goes under 225, we're going to get out, because the Russell is a much better mover than the Dow. I'm expecting him to go 45.60. I'm expecting this to get over 2088, and I'm expecting this guy to stay over 17,560. If any of those things don't happen, we should get out. If 2088 just got touched. Because what I'm assuming then is he's consolidating for a move higher. All right, and if he makes a move higher, then he could really poke up. Once he gets over this resistance, he can really jump up nicely. Not happening, though, going the other way. Here's 62, here's 59. But these guys are not rejected yet. In fact, if you look close up, you see how that's the line? Let's see if we can get closer on that. Oh, look at that thing. There's that line. There's these little red dots. That's your resistance line, and we're just over it. So as long as we're over it, I'm feeling good. There you go, 62, 87, not quite there. Could be better. And really, so you got to watch things. That's what you got to do. You've got to start watching very closely to get confirmation that the move is going in your favor. What is this? How weird. This is, I'm sorry, I got to fix this. It's kind of annoying like it is. Just adjusting the, there you go. Now you can see it better. That was very strange behavior because it never showed me the 8. Up now, failing. 207 is pulling back a little bit. 222. See, now I've lost money. That's how fast we lose money, too. 221. If 220 fails, we need to get out of this. But it's not. Now, if I wanted to get down, now let's say I want to make my average 1225 like I originally wanted, so all I have to do is buy another one. Now I have 2 at 1225, which is where I wanted to be when we started. I could change my average. But now I want to sell 1 to get back to my 1 contract that I wanted to be in the first place. So I immediately put in my sale order at 1225. That'll leave me with 1 contract at 1225, which is where I wanted to be. Now, at the same time, I'm thinking, like, what am I going to do if it fails? Well, I've got 2 contracts here already. I'm not going to like that. But what I want to short, then I would want to short whoever is the highest flyer, and that would be the S&P. If these guys start failing, then the S&P is going to start failing, and I want to, because they're the boat, they're getting tugged, right, by these boats. So if the S&P begins to fail, if all these guys begin to fail, I'm going to want to get short on the S&P. And now I want to watch Apple, especially if Apple starts falling, then I want to short the NASDAQ too. At the moment, I'm still okay with my long. I just want to see what happens. And by the way, that does happen. You will lose money in the future. You know, you're going to watch it go up and down. But now we're down 100. Remember I said we should get out at 1220? So just going to have to watch it closely and see what happens. I could do an insurance play here and just short this. But I don't like to bet against myself if I can avoid it. We're not getting a real negative signal, but we're just sort of, the Russell is really not behaving itself at 12250. All right, but that's, we expected that to be resistance, so it's not terrible, but it is. But it is disappointing. So now you're basically watching. Are we making progress in all 3 of the guys? The other 3 guys we're watching, are they all making progress, or are any of them failing? And now we want to do a quick check on the dollar. Dollar steady, gold steady, oil steady. Oil's ticking up a bit. That's good for the S&P. Silver ticking up a little bit. And back to the indexes then. So in other words, no major changes, no news changes, nothing really changing our outlook right now. So we're just watching to see how it resolves. Look, 1224. There it goes. See, I filled. So now, now that it's filled at 1225, now I'm left with one at, well, it says 1224. That's not actually correct, though. I have one at 1225. All right, so that's fantastic. So now, if it goes back to below 1225, I stop out even, which I'd like not to do, but I will if I have to. So now everything above this line is profit. All right, so that's called scaling in and scaling out. You have to be very careful. You have to understand your risk when you do that, and you have to be sure that you can afford it, because one second you do that, you're now risking $20 per point per contract instead of 10. All right, but it allows you to get a better position. It's called actually laddering. You're laddering on these, and it's because it looks like a ladder, right? And if I get in and out of these positions, in fact, let's do this. Oh, there you go. There's $60. And I like it, so I'm going to take it off the table. Oh, there you go, profit. Now I'm up $70. Now we're up $70 here and $15 here. That's $85 in the 1 hour we've been talking about this stuff. Just trading single contracts. All right? If you practice, you can learn to do this every day whenever you feel like it. All right? And if you're lucky, sometimes you can get, like I said, this is not an opportune time to get in and out. We're just doing this as examples. When we do, when we pick the right spots, you can make hundreds of dollars in an hour, not just $100 in an hour. But still, $100 in an hour is not bad, right? And sitting on my butt. Sitting on my butt, chatting to my friends. Not such a bad way to go. And also, I wanted to get out because I got other things to tell you, so I didn't want to just sit here and stare at this thing all day. But as you can see, we're going up and up. We're nice and, anything over here is pretty safe. And as long as these guys keep making progress, you can stick with it. You didn't have to get out. But I'm just happy that we make $85. I mean, that's pretty good, right? Not wasting my time doing it. All right, questions? Nobody's asking questions, though, so I could have stuck with it. Advanced declines. That's a good thing to watch also, the advance and decline lines. And I would expect that. Pat says 55 on YN. What, did I miss something? No, I got out of the YN. Oh, you're still in it? Well, that's good for you. So I took the money off here because I was satisfied with that gain. All right, and look what happened. That turns out to be the top at this exact moment. Obviously, we're going to hit again resistance. Any even number like that, like 2090, you're going to hit resistance, and then you've got the double whammy of that being S2. Very unlikely you're going to pop that in one session. Doesn't happen very often. That's why they're there. Okay, it's very unlikely you're going to pop that support line in one day. So it's going to likely 2060 to 2090. That's a 30-point move. You're likely to get a 6-point retrace, 20% of the move. You're likely to get a 6-point retrace off that line, so back to at least 2085. So we'd be looking for right about here, and actually you can see how there was resistance there anyway. See how that kind of had a nudge at that spot? This line is where we expect to pull back to 2084. All right, so if you want, to be a strict technical person, I would call a short right there. But I would want to see the Russell fail their line. Dow we ignore because it's stupid. And I'd want to see the NASDAQ fail its line. If the NASDAQ fails its line, so now we can move to the other side of the table and start shorting. Because we think this run is exhausted. And we want to see now we want to see 1750 fail. 550 fail. We want to see this begin to turn red. We want to see these guys fail their support lines that we were just looking for as longs. And hopefully we'll get a sell-off into the close. Now, don't get a lot of sell-off into the close, but again, this goes back to we thought that we'd finish up at 1%. So here we are, 1%, almost 1%, 1%, almost 1%. So we are right where we thought we'd be for the day for the bounce. All right, that's why we had an itchy trigger finger to get out of this play, because it really was pushing the limit. And again, like I said, this isn't the ideal time to get in. The ideal time to get in was back here when it opened. You know, when I wrote the article and said I expect a 1% bounce, that's when you get in, not at the top of the 1% bounce. All right, so every day you got to pick your spots very, very carefully. Oh, there goes 1225. Ooh, dare I short the Russell? That'd be fun. Oh, too fast, too fast. Okay, let's short the S&P. We haven't done that yet. Yeah, I feel good about that. Okay, so now we're going to sell. And by the way, this is all you do. This is the sell side. Can you see it says sell? And this is the buy side. And all you do is click at the place you want to buy and sell. This is the bid. This is the ask. So for convenience, and again, I'm not messing around here. I'm teaching a thing. So I'm just sticking my thing in right where there's an obvious buyer. These guys, 1,000 people who want to buy a contract, I'm offering it to them. If I put my contract there, it would probably fill. But I don't want to sit here and wait for it. I want to show you what an active contract looks like. Now we have one short on the S&P at 2088. My premise is that 1225 is failing. My premise is that 17,550 is failing. My premise is that 45, whatever this is failing. This red line is failing, whatever it is. All right, so I've made my bet. Now I'm going to sit here and watch it for a few minutes and see if my premise is holding up. I'm going to check my charts. The dollar not moving, gold not moving, silver not moving, Nikkei sitting where it's sitting, who cares? The oil is still up a tiny bit, but not really jumping. Everybody else is kind of steady. Okay. The VIX, that's good to watch too. The VIX isn't getting more excited. The VIX you want to see going up if you think the market's going to go down, you'd like to see the VIX going up. So back to our trading screen, and the VIX wasn't confirming, and there you go. There's your problem. But still, you know, it's not like you expect something to happen the second you do it. Obviously, it's the trend we're looking at. This I believe is a toppy trend. See how that flat lined here? Then this one flat. It spiked up. It came flat. This guy's flat. They're having a lot of trouble here now. Maybe they're poising for a move up, but that's not the signal I'm getting from the Russell. The Russell's telling me we're going lower, and the Russell has been our lead tugboat for a while. So we assume they know what they're doing. Maybe they don't. The S&P and the Dow, though, are the best ones if you're a beginner because it's only $12.50 per quarter point, and they're very slow to move. And the Dow is $5 per point. And up. I don't know why these things aren't showing me the prices like they should. There we go. There we go. That's much easier. Oh, I still have that problem here too. Okay. There we go. All right, great. Now, I did get the spot I wanted, 2088, so I'm not looking to change it or add to it or anything else. If it's going this way, I'm just wrong, and hopefully it won't last. It's not moving quickly the way I wanted it to. And now we'll check the news again since we're not sure what's happening. First, let's see if anyone has a question. All right, so Pat made some money. I'm happy about that. Dan says, did you ever suggest adjustment for MYL positions in the LPP? We're not running from the stock. We still like Milo long term. We're just going to have to change the way the position is, and I haven't done that yet. I will be sending that out. We just emailed out the other ones, all the adjustments, so it'll come up also shortly, hopefully. Let's see. Oh yeah, let's see if anything happens since we last looked. This is why I like to keep it on today so far. You know, as a choice, it says, well, if I wasn't in it, it would say today so far. Because it freezes it at the last place I look. So now I say, oh, 114. So now I have to only look back to 114 when I do this. Assuming it refreshes. My mother has a much faster internet than I do. I found that out when I was in Florida. Very upset. All right. What's happened since 115? Oh, yeah, we have Twitter. That's great. Wells Fargo, Wells Fargo launches a commodities hedge fund. Okay, actually, it's a good time to buy commodities, isn't it? Well, I think so. Oh, we're speaking about gold, too. I'll get back to that. Angie's List, very nice. Oh, Angie's List, but the shares are plunging, and then they buy it. I don't know. You guys, I'm always suspicious about that, because sometimes it's like a big show when they, guys are like, I'll buy some stuff. Look, 26,000 shares. Big deal. All right? You go 26,000 shares at $3. All right, this is not big. So the funny thing is the headline makes it sound like really impressive, but Angie's List is up 9% after directed buys some stock. He bought $100,000 worth of stock. And because he bought $100,000 worth of stock, where's my million? Such a silly thing, I don't even know. ANGI. Here's what's funny. Just being slow for some reason. Okay, so Angie's List popped 10%. It popped $20 million because this guy bought $100,000 worth of stock. That's ridiculous. And let's see what that looks like. Inside the transactions. Well, I don't know if it says who it is. There you go. Okay. So now inside the transactions, who is Michael Moore? Do we see him anywhere around here? Oh, there he is. Moore, Michael. He purchased stock at $6.56. He spent $100,000. So he's just dollar cost averaging into his loss. Michael Moore. Nope, he's not a big buyer of stocks. He bought the stock when it was $6. This goes back to 2013. So in fact, I think we can click on his name. We'll get a little summary, but I think that's it for him. He's not even showing up here yet. It's a good behind-the-scenes thing of what I do when you when I'm not writing. This is what I'm doing. I'm like looking at things like that bother me all the time and saying, I wonder if that's going to be anything interesting. 90% of the time it's not, but every once in a while. Damn it, where'd he go? There he is. Oh, then he's got a couple of purchases. That's history. He's buying stock. Oh, he was forced to buy this stock. Automatic purchase. I wonder why that was. So he bought 12,000 at 8. Then he bought 15,000 at 6. Then he bought 21,000 at 4. And now he bought 17,000 at 5. Well, I got to say this to him. He does believe in the stock, doesn't he? I mean, that's like it's almost 100,000 every time. 100,000, 100,000. Little less than 100,000. Okay, so he's consistently buying stock. I got to say that guy's legit. All right, so this guy believes in the company. So sometimes I see these and I call shenanigans because I say this guy, this is a bullshit buy, but he's legitimately picking up some stock. He spent $1 million buying the stock in the company. So maybe he does think this is all ridiculous and the thing's worth more. All right, healthcare roundup, that doesn't care. Visa, partners with Stripe, I knew about that. Oh, see, I read some of these things, I'm like, I knew about that like last weekend. That's weird. Radware down, who cares? Oil sands projects displaced. Well, that's different than pipeline projects, actually. This is oil sands, pipeline projects. Still, less oil moving. If pipelines aren't there, then there's less oil coming into the country, and that helps oil move up. Oh, I thought we had a bet on. Luckily, nothing's happening. So that is a positive factor for oil. And now we're kind of back to where we started, right? Ethereum, I remember that one. All right, so nothing. So there's nothing really moving the market particularly. Not in the news seeking out the court. That doesn't mean that nothing's moving the market. It just means that they're not showing it at the moment. And I'm just using them for convenience. So there's no reason I think that we should be on up or down. And therefore, I think my technicals are going to hold up. My technicals say we're going to pull back probably 3 points at least here on the S&P into the close. That's what we're playing for, very simply. What else? Gold. We were going to talk about gold. Didn't we just talk about that today? Let's see. Nope, not that one. Nope. I wrote a whole lecture on gold. I don't remember where I did that. Was it yesterday? Oh, wait. Wasn't there. Okay. Must be yesterday. Huge conversations in chat, and I'm always like, what is that? Wrong button. So I believe it was at the end of the chat yesterday, or early this morning, really, and I wrote a whole disposition on ABX and gold. I apologize, something is slowing down. I know it's probably kids coming home from school. Oh, they're not in school, but from camp with a big torrent. Oh yeah, here you go. Great. So we talked about this morning in our member chat room in the context of ABX and why I think it's ridiculous how low they are. This goes to gold too, though. It's all in one. Gold production. The all-in cost of gold, that's how much the cost of acquiring the mines and mining the gold and so on and so forth, right? So Barrick's all-in cost of gold here is $11.28 a pound. So it doesn't pay for them to sell gold below $1,100 an ounce. All right, this is the average price in Q2 has been $11.92. As gold goes below $11.28, why would they sell it? Now, their extraction costs, in other words, they already blew $300, let's say, or $250. So they cost them $250 an ounce to buy the gold. Then it costs them, in other words, to buy the rights to the gold. Then it costs them another $877 to extract the gold from the ground. Now, they already blew the gold. They already spent the $250. That's the gold they have. Now it's going to cost them $877 to pull it out of the ground. They have to make a decision every single day whether or not the marginal return on the gold is worth it. Now, from an all-in cost, it's not worth it. It's below their level. All right. So on a marginal return, though, the cash flow wise, they make even at $1,100, they make $250 an ounce or $225 an ounce. So they may, for cash flow purposes, still want to pull the gold out. But on the whole, though, the actual cost of their mine and the gold in the mine and so on and so forth is $11.28. So they're really losing money on their books. They already did a massive write-off, so it's not going to show that way. It's going to show as profit. But the reality is they're not too keen on doing it this way if they can avoid it. All right. Also, copper. Okay, so their allocated copper cost of $2.28. They need over $2.28, so it's very important that copper stays up for them to make some money too. At the moment, copper is $2.40, not $2.70, so it's a big deal. That means their projections go lower and lower. Gold's $1,100, not $11.92, so the projections go lower. All right, so that's not good for Barrick, but it's in a downtrend. Now, what's really important, though, about this is when you look at all the miners, Barrick has one of the best sustaining costs of gold. Most miners are in the, they're more like the $1,000 range. About $1,050 is about the right price for the extraction cost of gold to the average miner. So if the extraction cost, not the all-in cost, not the cost they paid for the mine, but their cost of extraction is $1,050. So if it costs you $1,050 to pull gold out of the mine, and you can sell it for $1,050, is there any logical reason? This is not like it doesn't help your cash flow because it costs you physically. You have to spend. You have to take $1,050 out of your pocket, give it to the workers and the whatever and all the equipment and so on and so forth. You have to spend all that money. And then when you sell your gold, you're going to get back $1,050. That's a waste of your $1,050, right? You're better off leaving the $1,050 in your safe and telling all the workers and everybody to go home for now. Now, There are considerations such as, well, I already have the equipment, it's just sitting there, and I got to pay for that. So maybe your cost of not mining the gold is still $400, right? Because you could send all the gold workers home and not use electricity and not use oil and not use gas and not do anything, but you still got to pay the leases on your equipment. That's what all-in sustaining costs are. So there might be some portion of those all-in sustaining costs you can't get away from. So that would be an interesting statistic. What does it cost you not to mine your gold? And maybe it costs you $400 not to mine your gold. Then the decision is different though, right? Because then you say, well, I'd rather break even than lose $400. That's how come you see sometimes a commodity go below what you would consider a logical price. But it doesn't last because the business can't operate that way. You're not making any money. And eventually you start losing money and you can't pay your loans and so on and so forth if you have no profit. So either way, what happens is production starts shutting down, either slowly or quickly, but production starts shutting down. With oil, look how slowly it's been. It's been taking forever for oil production to cut back in this country. Same thing with gold. It's going to take a long time to cut back, but as long as Barrick survives, then it'll be okay. Now, people talk about Barrick's debt. Barrick has, let's say, $20 billion in debt. Let's say that debt's at 5% and they have to come up with $1 billion a year to pay off their debt, right? They have 5% interest rates, they need at least $1 billion a year to service their debt. So, if Barrick does nothing, they still have 100 million ounces of gold. So they got 100 million ounces of gold, and we just saw a big sale of a mine. So at minimum, you get $250 an ounce for your gold. That's $25 billion. So they have $25 billion worth of gold in the ground that they could sell without mining it to other people. That equals their debt. So if they sold all their mines and all their stuff, they would get $25 billion back and they'd have no debt. All right? That to me is a good investment. I like that investment better than buying gold. Because it's not going to be easy. Even if gold goes down in price, it's not going to really erode the cost of buying a mine. Nobody's going to let a mine go for $150 an ounce. That's not going to happen. So really, that part is going to go down very, very slowly, probably in the same percentage gold goes down. So if gold goes down 10%, then your sale cost for raw gold mines is going to be $225 an ounce instead of $250. So you're going to lose a lot less with the miners because they can still survive, and they're certainly gold. They're just going to sell enough to pay off their debts this year. And that's why you hear people say, oh, they're going to go bankrupt and this and that. No, they're not, because somebody's going to buy one of Barrick's mines for $500 million if it has 2 million ounces of gold in it. That's all. They have 2 million ounces of gold. They'll sell it for $500 million, and there you go. And of their total 100 million ounce reserve, that's not a big deal. So that's how this works. So gold can go much lower. Barrick has already sold some mines. They've already put gold on it. They've already put cash on their balance sheet to ride out what they think is a fairly short-term correction. I think gold bottoms out at $10.50 though. There's my official logic to that. I think $10.50 is the right bottom price for gold. Does not mean it cannot go lower, but it's certainly where I want to plant my flag and start taking a long position. Can you go over the Kevin O'Leary map you mentioned earlier? Hang on. Let's see how this looks. Oh, good. Ha ha, look. So I wasn't paying attention, but we made our money. All right, so everything's going our way, doing exactly what we thought it would do based on the exact 5% rule I teach you guys all the time. I just did the logic. All I did was I said, here's there, minus this, that's where it goes. It's very simple. All right, this is very, very easy to make money like this. All right, so it's $100. I'm happy with this $100. If I want to lock it in here, because I really, at this point, we're up $200 for this meeting. All right, so I think that's pretty good, right? Make $200 during this little conference. We could do better. We'll see how it goes. So far, nobody's ticking back up. So if nobody's ticking back up, I have no reason to stop out. All right, probably, obviously, we're going to hit here. It's going to be resistance. This guy already failed. He's got a long way to go before he hits resistance. He's got a long way to go before he hits resistance. We calculated a 6-point pullback to 84. That's where that was our goal. We're at 75. We're still a bit higher than that, so we might do a little better. And we'll keep an eye on it. So Chrissy asked about the Kevin O'Leary math. The Kevin O'Leary math was, I was saying, because Kevin O'Leary was, here's O'Leary's statement. O'Leary's on CNBC, and he's saying, hey, why are people upset in China? Because in China, the market went up 150%, and now it pulled back 40%. What's the big deal? All right? Now, when you hear that, you kind of in your mind, this is a math trick, okay? So when you trick kids in math, and unfortunately you can trick almost any American this way too, because nobody's very good at math. The math trick is that if you do his logic and you say, oh, well, it's no big deal because it went up 150%, now it pulled back 40%. That's not really what happens, though, because when you take 2,000, the original price of the, if you take his logic, 150% is really going back very far. So that's not really the gain we've gotten, but let's, see these guys are now turning, see those green dots, green, 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 get out. Buy, sorry. As soon as, when you have a little play like this and you make your money and you see that little green dot there and that little green dot there and that little green dot there, it means everybody's turning back up. So get the hell out of the trade. I made $100. Get out. Take the money. It turned. This is very, very short-term momentum trading. But you know what? Practicing this stuff and getting good at it, you can become a fantastic momentum trader. Now, those green dots are probably breaking now, but you know what? I could always take another one. I could always watch these lines and take another one off the next mover. I can get back in this one, but I'm not going to right now because we've got to wrap this thing up. But you can always get back in. You can always say which one now is the best bet. You can always switch your horse and get what we call a fresh horse. Like right now, the NASDAQ would be a fresh horse unless Apple is still up, which it is. So I'm not going to bet against Apple, so the NASDAQ's out of my equation. That means I'm going to take these three guys and see who's got the best line. The Russell has the best line because I think it's going to have a hard time getting over 1220. So I would have gone short on the Russell, and look what happened. So right there, I could have gone short, and we'll see. And then I would use a stop up here at 1220. The other thing about the futures is whenever, the best way to enter futures is whoever has the best stop loss. The one that gives you the least amount of loss when you would stop out, that's the best one to get into. Oh, that was a shame. I should have taken that one. That would have already been $50 right there. $50. Boom. Now it's going to go 50 more dollars while I'm talking about it. But meanwhile, I can get right back in the S&P because I got out right about here. So I could go back to selling this. But I'm not, like I said, we're wrapping this up, so I'm not going to. But that's all you do. You take your money quickly off the table. Don't sweat the fact that you're out. And there's going to be another opportunity. What happened? Like 3 times already during this little hour and a half thing, we've had opportunities to make a little bit of money. So here's $100 here and $70 here and $15 here. That's $185 in an hour and a half. And you can do this all day and all night whenever you feel like it when you learn how to do this properly. It takes a lot of practice, but you can, Thinkorswim especially, the Thinkorswim is from TD Ameritrade. You can open up a paper trading account. You don't even need actual cash, and you can play with this stuff day and night and just get good at it. Practice your entries, practice your exits, practice watching things, and the next part is just to get the logic down. The logic comes from, either my site or somebody else's site, somebody who's good at interpreting the news and calling market direction. If you're not good at it yourself, you just follow. Just find somebody who's got good instinct, and eventually you'll hopefully pick up some of those instincts yourself. Where were we? We were talking about gold, weren't we? Oh yeah. No, I'm sorry. We were talking about Kevin O'Leary. So let me see if I can find the Shanghai. Here we go. That's not stock shorts. That's stock shorts. Okay. So, unfortunately, everybody has a different DJSH. Everybody has a different number, a different scale. So in this one, the Shanghai goes from 300 to 700, which is almost the same thing. It's really, look, here's 250. So using this chart just to make it not too complicated, although it's probably going to make it more complicated because it's different numbers. But you go from 250, 250, times 150%, so times 2.5 is plus 150%, is 625. Well, it's not. I wish I had a better way to show this. All right. Let's call it 300. From 300 times 2.5 is 750, of course. So let's say that's what it did. So you have a move from 250, which is what Kevin O'Leary is talking about basically, to 750, which is up 150%. Now, when he says, but it pulls back 40%, you're thinking you're still up 110%, right? But you're not, because up 110% from 250, 250 times 2.1 would be 525. Wait, it is up 525. Well, I'm sorry, this isn't a 40% pullback. That's why it's different. I'm sorry, this is making it messed up because there's a big difference between 715 and 750, so it's not going to be a good example. But what Kevin O'Leary is saying, anyways, you start at 2,000, you gain 150%, which is 2.5 times 2,000. That gets you that. Yeah. 123 times 2.5, 5,000. All right. Now, when he says you're still up, you only lost 40%. It's not only 40 because 40% times 0.40 of 5,000 is 2,000. You're not losing 40% as if you're still at 110%. You're losing 40% of a much, much larger number. And so the pullback is huge. It's 2,000 point pullback. And that is essentially what did happen here. Here your gain, you went from 250 to 700, which is how much? Let's say 700 is 250, 700 minus 250 is 450. So you gained 450, but then look at this drop. You drop from 700 to 450. It's 250 points. That's 100% of where you started, not 40%. So he's mixing the percentages. He's applying. In other words, what he's doing is applying the 40% drop to the 250 you originally had. That's not what it is. The 40% drop is off the new total. And unfortunately, very, very unfortunately, for the people who got in at 450, everybody who bought here and here and here and here and here and here and here made no money. And the people who bought here all the way up to here, so everybody bought between March and July, or June, sorry, everybody bought between March and June. If they didn't get rid of their stock, they lost. And all these people here, and this is where the real frenzy came, right? The big bubble frenzy came right here. These people lost their shirts. They got, in one little thing, in 1 week, boom, all this got wiped out, 2 months worth of buying. The next week, boom, another bunch of guys got wiped out. And the next week, all these guys got wiped out. Now you're all the way back to March. And they got killed. And even worse, here's the thing that happened. The margin, people were borrowing on margin, and all they were doing, though, who convinced them to buy on margin? Who convinced these people to come in and buy on margin? Who convinced all these new accounts to open up and buy more and more margin? And I was showing this in chart after chart after chart, how it got exponential. More new people coming to the market, more margin buying, blah, blah, blah. This is all the stupid money came in late, and their margin, they were encouraged to come in by all the people here who wanted to sell. And they started pushing their government friends to tell people to get in the market. The brokers here, these are the brokers. These are the rich people. So the brokers and their clients convinced all the poor people to come in with their money and start buying at these really high prices so that they could sell their stock here, and then they don't give a crap what happens after that. And it all collapses. And you know what? Every day on CNBC, every night on the Jim Cramer show, that's exactly what they're doing. They're telling you to get into a stock that they already own, and they're just dumping it on you. And that happens all the time. But you know what? We can take advantage of that because we see it happening in the futures. We see these run-ups. All right? As I was saying earlier, I'm not excited about shorting here, but when it gets up to here, I'm very excited about shorting because this is too much. This wasn't too much. We went long here. But this is so much that we say, you know what, that's not likely to keep going. And then we make our short money. And if you learn to recognize these patterns and recognize these rules, especially like using these pivot point charts and learning that a stock does not often go very far from a standard deviation. In fact, let's take a look at a futures trader. Oh, no, really? All right, wait, chart, flexible grid. Ah, there we go. There's a nice one. Ah, look at the Russell. Great. So this is just a longer view. It's a 1 hour view. And look at this. How often do we really go more than 2 standard deviations in a day? 1, 2, 1, 1, 2. This is, look how wide this, the standard deviation is wider because you're more volatile. So that's not even 1 standard deviation. Now here, oh, here's a bad day. 1, 2, almost 3. Okay, that's 1 day out of so far like 5. 1, 2, 1, 1.5, no. 1.5, no. Ah, big one here. 1, well, wait, okay, so 1, 2, 3, 4. Very bad day. So there's 2 days. Then no, and this one is not even 2. This one's not even, this one is 1, 2, call that 3. All right, and I imagine this one was 2. No, maybe not, because it's such a wide thing here. So out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 15. So about 3 out of 15. So let's say 1 out of 5. So only 20% of the time are you going to go past 2 standard deviations in a day. Which means that when you are at 2 standard deviations, so when you're in your day and you're at 2 standard deviations, then statistically you have a very, very good chance that it's not going to break. You have a 4 out of 5 chance it won't break. Isn't that good information? Using that knowledge, you can make some effective trades. But the trick is here, this is something I really try to get across to people that people don't understand. The trick is here, don't play if you don't have something weird going on. Because here you have 2 standard deviations down, it's obviously logical to go long. Here you have 2 standard deviations up, it's a good idea to go short, right? Those are not likely to break. But you know what? When you're in between, here, there's no reason to do anything. Don't play. Because I would rather play, here's 2 days, right? So in 2 days, I didn't have a chance to play here, but today I got 1 and 2 chances to play when I had an 80% chance to be right. And we were right. We were perfect, though, weren't we? Perfect. 3 trades, 3 winners. Because we waited for the right opportunity. And this wasn't even the best opportunity, but it was the best opportunity we had during this session. All right, so I hope that comes across. It's like you just have to be patient. You have to wait for a really good setup, and then you have to play it. And for those of you who aren't members, we talk about this stuff and do this stuff every single day at PSW. At least once a month, we try to talk about futures in these workshops. Usually, though, we'll talk about the market and all kinds of other stuff. All right, but it takes practice. It takes a lot of practice, but when you get good at this thing, it's just like a little money machine. It's fantastic. And also, it really helps you with the hedging. That's the article I wrote about on the weekend. And I didn't rehash it here, but that's a very important point, too, is it really helps you hedge your other positions. All right, last questions, and then we got to get this thing wrapped up. Phil, you turned off your screen share. What? Oh, no. No. Oh, I showed such good things. I had no idea that happened. I'm so sorry, guys. Oh, well. Just imagine there was all kinds of brilliant stuff happening. Ah, damn it. I cannot believe that. I must have hit the wrong button doing something. I don't answer my phone these days? All right, well, I do. I'm terribly sorry, guys. I don't even know how to restart at this point. Damn it. Oh, I tell you what. I'm going to reshare my screen. Wow, I cannot believe that happened. Am I sharing my screen now? Is anybody still there? Oh, there it is. Start sharing. Got it. You know what happened? I must have accidentally closed this little app. There's this little thing here that shares the screen. Somehow it must have gotten closed. Wow, that sucks. Yeah, don't do the Q&A, guys, because I can't see the Q&A. I mean, I can see it, but I have to go look at it separately. Something at 120 Apple puts. Yeah, no, I'm not doing anything with Apple unless it has a nice sell-off. I mean, we're happy where we are. Yeah, Chrissy. Well, the seminar is free. So, you got a free seminar. All right, let's see. How to share your screen. All right, done with that. All right. All right, sorry about that, guys. All right, so was there anything? I don't think the recording is going to show the last 10 minutes. I'm pretty sure that. I don't know, actually. I really don't know what's going to happen. What was I talking? Was I talking about? What would you like to see that I did that maybe you missed? God knows, right? I was all over the place. I'm terribly sorry about that, guys. Anyway, so here's where we're wrapping it up, and we had this bounce, and like I said, this is the point I was making about the deviation. So, oh, that is important. I'm sorry. So we went to this chart. And I had this long thing of the Russell. And what I was saying is if you look at all these different days, there were only 3 days out of 15 where this thing moved more than 2 standard deviations. And the Russell is, by the way, the most volatile of all the indexes. So my point was that that means that when you're looking at the charts closely here, when you see a 2 standard deviation move, it's probably going to retrace. So here you have 2 deviations, 2 deviations, you have 2 deviations down. When you see that, that's probably going to be a good support line. And since I already know historically that 80% of the time that line's going to hold up, one way or the other, whichever direction it is, then I can play that forward bounce with a very high degree of probability of winning. And that's what it's all about. If you consistently take high probability trades where you're going to win more than 60% of the time, then all the other part is only cash management. And by cash management, I mean making sure you don't lose too much. And how do I make sure I don't lose too much? The same thing. I take my bet below this line, and I say, well, above this line, I'm going to quit. So I have a very tight stop because I'm going to quit if my premise is blown. So my losses, when I have them, are going to be small. But then when I win, sometimes, not all the time, a lot of times I'm going to take my little $100 wins and run away. But sometimes I'm going to get lucky, and let's say right here I've gone short, right? Sometimes you get lucky and it just goes down, down, and down, and down in your direction. All right? Now, if I had gone long here, not that I would because it wasn't a really good run, but if I had gone long here, I would have stopped out right down here with a small loss, right? But then if I had gone long here, taking another poke at it, I would have lucked out and gotten a huge run back up. So this is what I mean by you control your losses, and you control your losses by making good entries where you have a good tight stop that you can see visually makes sense, that you can easily see when the trade's going against you and get out of it. But on the other hand, and also in the same way, because I'm taking my entry here, if it does start going my way, it doesn't have a lot of resistance going down, and I have a chance to make good money. And here's the thing. If you do this, and let's say you're only right 6 out of 10 times, you're 60% right, right? Let's say you make and lose exactly $20 each time. Well, you know what? If you make 20 and lose 20 and make 20 and lose 20 and make 20 and lose 20, but then make 20 twice because you got 6 out of 10 correct, you win $40. So then it's just a numbers game, right? The more you play, as you keep playing, as long as you keep playing when it's in your favor, you're going to make, and $40, don't forget you only started with $20, right? So you got 20, you start, well, let's say at $100, and you're going to play 20 win, 20 lose, right? If you're starting with $100 and you make $40 on 10 trades because you're 60% accurate, that's a 40% gain. That's fantastic. If you do that once a week, you're going to get very rich. Okay? If you make 40% once a week, you're in good shape. So people don't appreciate that. It's just, you just have to get consistent and don't swing for the fences. Take the little wins because those little wins really add up. And take those little losses because you're wrong. Get out. It didn't work. And that's really the trick to it. And then again, we teach this every week. We have all sorts of tricks that we work on for this stuff. But those are the basics. And it's just such a wonderful way to be able to trade. I cannot stress enough how it's worth learning. All right. TF standard deviations, right? We did that. Apple daily high, so we obviously wouldn't want to short anybody if Apple's plowing up. Apple pulls the NASDAQ up, it pulls the S&P up. It's the ultimate stock, really. If you want to manipulate the markets, buy Apple into the close or sell it, depending on what you want to do. Does anyone know where to trade futures in Canada? TOS in Canada only trades options, interactive brokers. Well, I guess you want to open up you kind of have to put money in an American bank and open up an account there. You can do that. You have to call TOS to ask them what they do. But I'm sure somebody trades futures. I can't imagine nobody does. It's like a pretty standard thing. It might just be Thinkorswim doesn't do it. I love Thinkorswim's platform, though. I use it all the time. Oh, I shouldn't say that. Oh, sorry. Next week's webinar will be sponsored by TradeStation, who we also like. TradeStation. It's great. Anyway, so we're doing TradeStation next week in the webinar, and it's just going to be an intro sort of webinar for the TradeStation people. So we're not going to have a regular Tuesday one. It's going to be like Tuesday after hours, probably 4 o'clock. We'll let you guys know exactly next week. But it'll be another free webinar. That's the good news. But on the bad side, it's really just going to be the basic explaining the Be the House concept and how to play with options and so on and so forth. But we are going to start a series of seminars with TradeStation. Not every week, but like probably once a quarter or something like that. So we can ask them if they have futures in Canada. I'm sure they do. Otherwise, yeah, I'm positive they do. And Chrissy's in Canada. That's right. She uses Interactive Brokers or TD Waterhouse or Thinkorswim. Well, that's interesting. Well, she says Thinkorswim, but you say not Thinkorswim. I don't know what the answer is. All right, guys, now we're done. Who used Q&A after I said don't use Q&A? James Coe. He said LOL. All right, anyway. All right, good. All right, well, that's our webinar. Thank you all for coming. I hope we had a good time, and we will, of course, do it again. I love talking about the futures. It's just a lot of fun, especially because, look, most of our option setups, if you look at these plays in our long-term portfolio, there it is. Okay, they're well, that's a short-term portfolio. They're almost all 2017. Where did I have that? Here. Wherever I had them. Oh, there they are. Look, almost every single thing is 217, 217, 217, 217. It's like watching paint dry. I mean, these are great plays. It's fantastic to work on. But, during the day, if you're going to be sitting here being a trader, you got to have something to do. And frankly, I think futures trading is for idiots. People go in and out, and they do this and that. And meanwhile, you can just play these, not futures, I'm sorry, the people who day trade, like quick options and things like that and stocks, I think that's a waste of time because you can do it with the futures with so much less commission and so much more leverage. It's just, if you get good at it, it's a fantastic thing to do, but the trick is you got to practice it though. So many people go in and overcommit and over-leverage and over-hedge. That's where you can go wrong. But if you learn to do this correctly, it could be one of the greatest things in your life. That's why I cannot stress that enough, how much better control you feel like you have when you learn how to do this correctly. It's like if you're like a carpenter, like you like building things, you're a handyman, and you do stuff, and you usually have this one hammer and one nail, but then one day you finally get a good toolkit, and you say, oh my God, how did I ever build stuff without this? That's what it's like. It's like getting a good toolkit that you'll use for the rest of your life, and it will enhance everything you do in trading. Not only that, though, but the discipline you get from trading the futures comes really, really in handy when you start trading, in your regular trading too. So that's my commercial for futures trading. I hope you all enjoyed yourselves, and thanks for everybody for coming. And we will do it again, like I said, next week with TradeStation. All right, thanks.